Hello everyone, welcome back to my channel. Subscribe to the channel for tech stocks updates. The stock market is feeling the heat. Investors are nervous. The September jobs report is looming. This report is a big deal. It gives us a snapshot of the US economy. Right now, there's a lot of uncertainty. We're seeing inflation. Interest rates are high. The war in Ukraine continues. And let's not forget about the energy crisis. All these factors are weighing on the markets. Investors are looking for any clues about where the economy is headed, and the jobs report could provide some answers. The September jobs report is the talk of the town. Everyone on Wall Street is watching. Why? Because it tells us how many jobs were added or lost in the previous month. This number, known as non-farm payrolls, is crucial. It gives us a glimpse into the health of the labor market. A strong number usually means a healthy economy. A weak number? Not so much. But it's not just about the number of jobs. We're also looking at wage growth. Are salaries keeping up with inflation? The answer to that question will tell us a lot about the strength of the consumer. Let's take a look at the major indexes. The Dow Jones Industrial Average is down slightly, the S&P 500 is also in the red, and the tech-heavy Nasdaq is taking a bit of a beating. What's driving this decline? It's simple: uncertainty. Investors are unsure about the future. They're worried about inflation, interest rates, and the global economy. And this brings us back to the jobs report. A strong report could calm the markets. It would signal that the economy is still strong. But a weak report? That could send stocks tumbling. So what are economists expecting from the September jobs report? The consensus is that we'll see around 200,000 new jobs added. That's a decent number, but it's lower than the previous month. As for the unemployment rate, it's expected to hold steady at 3.8%. That's still near historic lows. It suggests that the labor market remains tight, but here's the catch. Even if the report meets expectations, it might not be enough to satisfy Wall Street. Investors are looking for more than just decent numbers. They want to see signs of a strong and resilient economy. The Fed's balancing act. The Federal Reserve, often referred to simply as the Fed, is currently navigating one of the most challenging economic landscapes in recent history. The Federal Reserve is in a tough spot. With inflation rates soaring to levels not seen in decades, the Fed is under immense pressure to act decisively. They're trying to tame inflation without causing a recession. This means they need to carefully calibrate their policies to avoid tipping the economy into a downturn while still reining in rising prices. It's a delicate balancing act. Imagine walking a tightrope high above the ground. One wrong move could spell disaster. The Fed's task is similarly precarious, and the jobs report will play a big role in their next move. Employment data is a critical indicator of economic health, and the Fed closely monitors these numbers. If the report is strong, it could give the Fed more ammunition to continue raising interest rates. A robust job market suggests that the economy can withstand higher borrowing costs. They've already hiked rates aggressively this year. In fact, the pace of rate increases has been one of the fastest in recent memory, and they've signaled that more hikes are coming. The Fed has made it clear that they are committed to bringing inflation under control, even if it means more rate hikes. On the other hand, if the report is weak, it could force the Fed to reconsider their plans. A weak jobs report might indicate that the economy is starting to falter under the weight of higher interest rates. They might decide to slow down their rate hikes. In such a scenario, the Fed would need to tread carefully to avoid exacerbating economic woes, or even pause them altogether. A pause in rate hikes could provide some relief to the economy, but it also risks letting inflation run unchecked. The Fed's decisions in the coming months will be crucial in determining the economic trajectory of the nation. A strong jobs report, good news or bad news? A strong jobs report might seem like good news. After all, more people getting jobs means more income, more spending, and overall economic growth. It's a sign that businesses are doing well enough to hire more workers, and that should be a positive indicator for the economy. More jobs, more growth, right? Well, not so fast. While it's true that a strong jobs report indicates a healthy economy, it can also have some unintended consequences, especially for the stock market. In this environment, a strong report could actually be bad news for the markets. Why? Because it can lead to higher inflation expectations. When more people are employed, they have more money to spend, which can drive up the prices of goods and services. Because it could give the Fed the green light to keep raising rates. The Federal Reserve, which is responsible for controlling inflation, might decide to increase interest rates to cool down the economy and keep inflation in check. And higher rates are generally bad for stocks. Higher interest rates mean higher borrowing costs for companies, which can reduce their profits and make their stocks less attractive to investors. They make it more expensive for companies to borrow money. When companies face higher borrowing costs, they might cut back on expansion plans, reduce spending, or even lay off workers, which can negatively impact their growth prospects, and that can hurt their profits. Lower profits can lead to lower stock prices, which can be bad news for investors who are looking for returns on their investments. So, don't be surprised if a strong jobs report sends stocks lower. It might seem counterintuitive, but the stock market often reacts to the implications of economic data rather than the data itself. It sounds counterintuitive, but that's the way the market works sometimes. Investors need to consider the broader economic context and how different factors like interest rates and inflation can impact the market. So, while a strong jobs report is good news for the economy, it can be a mixed bag for the stock market. Signs of a slowdown, what to watch for. While most eyes are on job creation, keep an eye out for signs of a slowdown. Job creation is often seen as a primary indicator of economic health, but it doesn't tell the whole story. One key indicator is wage growth. Wage growth reflects the overall demand for labor and the bargaining power of workers. If wages start to cool off, it could be a sign that the labor market is loosening up. This means that employers might not be competing as fiercely for workers, which can lead to slower wage increases. Another thing to watch is the labor force participation rate. This metric is crucial because it provides insight into the active engagement of the working-age population in the labor market. This number tells us what percentage of the working-age population is either employed or actively looking for work. A higher participation rate indicates a more dynamic labor market. If the participation rate starts to tick up, it could mean that more people are coming off the sidelines and looking for jobs. This can be a positive sign, suggesting that people are more optimistic about their job prospects. That would be a sign that the labor market is becoming less tight. A loosening labor market can have various implications, such as reduced pressure on wages and potentially slower economic growth. It's also important to consider other economic indicators, such as consumer spending and business investment, which can provide additional context to the labor market data. Consumer spending drives a significant portion of economic activity, and any slowdown here can signal broader economic issues. Similarly, business investment in new projects and technologies can indicate confidence in future growth. By keeping an eye on these various indicators, you can get a more comprehensive understanding of the economic landscape and be better prepared for potential slowdowns. Remember, no single indicator can provide a complete picture. It's the combination of multiple data points that will give you the best insight into the health of the economy. Stay informed and vigilant, and you'll be better equipped to navigate the complexities of the economic environment. Market reactions. Brace for volatility. No matter what the jobs report says, expect some volatility in the markets. A strong report could send stocks lower in the short term. A weak report could do the same. Why the uncertainty? Because the market is forward-looking. It's not just reacting to the latest news, it's trying to anticipate what will happen next. And right now, there are a lot of unknowns. We don't know how long inflation will last. We don't know how aggressive the Fed will be, and we don't know how the war in Ukraine will play out. Navigating uncertainty. So, how do we navigate this uncertainty? The key is to stay disciplined. Don't panic sell based on short-term market movements. Instead, focus on the long term. Make sure your portfolio is diversified. Invest in a mix of stocks, bonds, and other assets. And don't be afraid to seek professional advice if you need it. Remember, the market goes up and down, but over the long term, it tends to go up. Stay the course and you'll be rewarded. What's your take? So there you have it. The September jobs report is just around the corner. It's a big deal. It will have a major impact on the markets. What do you think the report will show? Are you bullish or bearish on the economy? Let me know your thoughts in the comments below.